Well, welcome, ladies and gentlemen, to Lower Your Income Tax Bill, Advanced Strategies. I'm Jim Cunningham, and we got a lot of material to cover today. This is a very hot topic. And one of the things that clients want to ask most about when they meet with us is, Jim, how can I reduce my income taxes? You know, I would say this is the area that really falls in the gap between CPAs, lawyers, financial planners. Oftentimes, this kind of fits in the cracks between these various professions. And frankly, I think people don't pay enough attention to lowering their overall income tax bill. This is a disclaimer. The information that we're providing today is that information. This is time sensitive. This is 2021. These laws change. They come and they go. New things pop up. Old strategies kind of fade away. So it's very important to stay current on this. And please subscribe to our YouTube channel. We're doing this live. We've got a lot of people attending on our webinar, but we are recording this. We will put this on YouTube. I would encourage you to subscribe to our YouTube page. We do have a lot of content that goes out, and with a whole new presidential administration and so much change going on in the world, it's really important to stay ahead of this because, you know, a lot of times things happen and then it's too late to do anything about it. So I'm glad to see that you're watching this and you're being proactive. I'm Jim Cunningham. I've been a lawyer over 25 years. We have offices throughout California in the capital region, San Francisco Bay and Southern California. I'm a certified specialist in estate planning, trust, and probate law. I'm also a real estate broker, securities licensed, and insurance licensed. So today, we're going to cover 3 key topics. The first thing I'm going to cover with you today is the concept of the tax benefit. So this is a term that CPAs and tax lawyers use to describe what it is that we're talking about. So the tax benefit is a succinct way to measure one approach against another. What is the single number? What is the tax benefit? You know, I've got 3 strategies, A, B, and C. How do I compare apples to apples or apples to oranges? You reduce it to a number, and that's the tax benefit, because this stuff can be pretty dense and complex, but reducing it to the tax benefit, frankly, gives us a single number, and that's the amount of tax that you won't be paying. Okay. Well, and we have a bifurcation here. We've split up the strategies for W-2 workers and retirees and business owners. So I will say that if you're a business owner, you have a lot more strategies than you do if you're a W-2 earner. But if you're a W-2 earner or a retiree, there still are some really good strategies. So let's go over briefly the concept of a tax benefit. There are 5 tax benefits that we look at when we counsel clients. And I will tell you, you know, many people live day to day, paycheck to paycheck. Many people live year to year. So they think about not in terms of how much do I make per week or what are my bills per month, but, you know, what is my income annually? I would say that the wealthier people, the more financially successful, right? Financially successful people do think year to year, decade to decade. And for our ultra high net worth clients, they are thinking intergenerationally, meaning they're thinking not only about this decade and the next decade, they're thinking about their children and their grandchildren. And frankly, that's how you build wealth. And I'm telling you this because I've seen it. You know, Warren Buffett said, get rich slow, don't get rich quick. So let's talk about tax credits. These are going from the best to, well, the not so best, right? So 1 through 5, 1 is better, 5 not as good. So what is a tax credit? A tax credit is an amount of money that is subtracted directly from your taxes owed. And deductions reduce the amount of taxable income. Tax credit reduces the amount of actual tax that is owed. And we'll go through an example here. So this is really important. I'm not going to presume that anyone has a knowledge of these different terms. This gets very confusing very quickly. And the credits the tax credits are based on a wide variety of factors. And it's whether you're an individual or a business, whether you're in a specific geographic location, a classification, or different industries. So there are a lot of different ways, but on a very high level, I do want to highlight the difference between a tax credit and a tax deduction. So a tax credit, let's assume Tom has taxable income of $1 million a year. Tom makes an investment that generates a federal tax benefit of $100,000, a federal tax credit of $100,000. Tom's federal income tax liability is $329,000. And because of the existence of this $100,000 tax credit, it reduces the amount of tax that Tom owes to $229,000. So you can see if you're looking at the tax strategies, if there's a tax credit, that is the best tax benefit. Okay. In most instances, it's going to be the superior thing that you'll want to go after. So what's a tax deduction? So a tax deduction, again, is that dollar amount is reduced from your income, your taxable income, and then we apply the tax rate, and then we get the tax benefit. Okay, so a deduction is, and again, the same example, Tom's income is $1 million. Tom makes an investment that is a federal tax deduction of $100,000. Tom's federal income tax liability, still $329,000. It doesn't reduce, the tax deduction does not reduce his taxes by $100,000. It reduces the tax on the $100,000. So his income tax liability goes from $329,000 to $292,000. So a credit, you can think of this, a credit is more beneficial than a deduction because saving $100,000 in taxes obviously is better than saving $37,000. And the tax credit saves Tom $100,000. The tax deduction saves Tom $37,000. I'm not talking state taxes. I'm just going through concepts here because we do use these terms, deduction, credit, throughout our time here today. And it's very important that you understand the distinction. Now, if you want to know which is which, this is how I remember it. C comes before D, credits come before deductions, and it's first in priority. It's the best. And it's also it's important to remember that it's worst first. It is your highest income tax brackets. When you get a deduction, it's your highest income tax bracket that you benefit from. Okay, so it's the highest bracket, the worst first. So what is a tax benefit? Let's talk about tax deferral. So we can get a tax credit, which is super good. That's the A+ standard. Tax deduction, okay, we'll take it, not as good. But what about tax deferral? I think this is a really overlooked area, is deferring taxes. So a tax deferral is a tax that is assessed or due for the current period. So we're in 2021. So it's taxes due for the current period, but has yet to be paid, meaning that it'll eventually come due in a different tax year. It might be 2022, it might be 2032, it might be 2062. We just don't know. And the deferral comes from the difference. So the benefit you get here, the tax benefit, we measure that by the time value of money. So if you choose to pay taxes now, or you pay them 10 years from now, but you're paying the same amount of tax, it makes sense to pay it 10 years from now, given the time value of money. You invest that money, you get a return, there's inflation, the future dollars you're paying at a lower dollar amount. Okay, so this is just a high level concept. So here's an example of tax deferral. Tom's income is $1 million, and Tom contributes $100,000 to a cash balance pension plan. Now we'll talk about what that is a little bit later. Tom's, again, his federal tax liability is $329,000. His income tax liability is reduced again by $37,000. But this is a deferral. This is not a deduction. So a deduction, you never pay it. But a deferral, you pay that in future years. So the tax benefit, again, is the time value of money. One day, the deferral period will end, right? One day, that deferral period, it's not indefinite, it's not infinity. And the tax on that $100,000 plus any growth in the investment, perhaps may be subject to taxation, maybe, it depends, okay? So there's some methods that estate planning attorneys use to eliminate capital gains tax on the death of an individual, for example. So I'd put in there maybe, right? So the tax deferral maybe. Paying someone else's taxes. Now, this is kind of an interesting tax benefit, and I'll give you an example here. This is used quite frequently with higher net worth individuals. It's been a common strategy for about the last 30 years in estate planning. It's something, and I hate to throw out technical stuff, but this is an example, an intentionally defective, irrevocable grantor trust. Now, people say, why would I want anything defective? Typically, an irrevocable trust, the taxpayer is the trust. Trusts pay taxes at higher rates unless they are considered what is called a grantor trust. A grantor trust means that typically some person is paying the taxes, and those taxes are paid overall at a lower rate. So an intentionally defective grantor trust, also known as an IDGIT, is used many times to freeze the assets of an individual for death tax purposes. So you can put an appreciating asset into one of these vehicles, and the future appreciation goes to the kids, for example. Again, you can see why this is common. If you have a wealthy person who says, hey, I've got this $1 million building and I think it'll be 3 million when I die. Well, it might make sense to make a gift of that $1 million building now. And that $2 million benefit goes to the children, essentially tax-free. But there's another really interesting benefit on this, a tax benefit that I think doesn't get enough airtime with lawyers and certainly CPAs, is the parent who creates the grantor trust is still recognized as the owner of the asset for income tax purposes. Now, what that means is I go ahead and I transfer a property to a trust, and that generates income. I pay the tax bill even though I don't own the property. Now, you may say, Jim, that's a terrible idea. But here's an example. Mom Gifts uses her current $11.7 million gift tax exemption. She transfers assets of $11.7 million, which you can do today in March or in May 2021, and there's no gift tax, right? So it's a completed gift for gift tax purposes. Well, let's say this 11.7 million kicks off 500,000 in taxable income. Mom might pay $200,000 in tax, right? But mom pays it, even though the kids own the property. So essentially, this is a way for mom to transfer another $80,000 per year and avoid gift tax. She can transfer another 200, but save 80,000 in gift tax because the gift tax is 40%. That's where I'm getting that number from. So conceptually, you set up an irrevocable trust, transfer assets. Those assets are the kids' assets, but the parent is deemed the taxpayer. This is another strategy that wealthy families use to essentially burn their assets and pay tax that might otherwise be due anyway. But you might as well have mom pick up the tab. It's like kind of like going to dinner, and mom she gets a Diet Coke or something, and the kids have the full meal, and she picks up the tab. Okay, that's kind of what's happening there. So avoiding tax penalties, I chalk this up. This is the biggest bonehead thing, I got to tell you. Again, people don't pay enough attention to this stuff. This is what we call basic tax hygiene. Okay, pay your estimated taxes, pay them on time. When your taxes are due, pay them on time. That avoids penalties and interest. I view penalties and interest, frankly, as another form of tax, right? But I don't think people pay enough attention to that. They say, oh, I'll just pay the penalty. Well, that can be a significant amount of money. And over time, it's a habit that tends to erode your ability to create intergenerational wealth. So one last thing before we hop into the actual tax strategies: avoid listed transactions. Okay, this is directly from the IRS's website, by the way. A listed transaction is a transaction that is the same or substantially similar, and this is where they get you, to one of the types of transactions that the IRS has determined to be a tax avoidance transaction. These transactions are identified by notice, regulation, or other form of published guidance as a listed transaction. You need to avoid these. And so I have clients come into my office. They'll say, Jim, I'm looking at this. I ask them, who, did this, and I identify the person. Did this person basically propose this to you? Yeah. How do you know? Because it's a listed transaction, and the IRS is really cranking down on that. So I would say that the individual tax planning community, income tax planning community, is very small, and it's a very small bar, very small number of lawyers that do it. We talk, we know what's going on, we're paying attention. We know strategies that are listed transactions. Nothing that I'm talking about here today is a listed transaction. So as they say, pigs get fat and hogs get slaughtered. Be a pig, don't be a hog. So let's turn to strategies for W-2 workers and retirees. So again, not all strategies are available to W-2 workers and retirees. This is a smaller subset. If you're a business owner, many of these are frankly available to you. Okay, so it's like the W-2 workers and retirees. Yeah, business owners can take those benefits, but the business owners also get a little bit more. There are some ways to reduce your W-2 wages. Some are well-known, some other are less well-known, and others are dependent on age. Basic, out of the gate, just basic stuff, guys. If you're working and you are not participating in your company's 401k, this goes to basic tax hygiene, okay? You really need to think about doing that. And I talk to people and they say, well, Jim, I'm making $25 an hour. I can't possibly afford to put away 4% of my salary. Are you kidding? What if the employer matches it? It's crazy not to put in the 401k, the 4%, and have your employer match it. And if you have kids or grandkids that aren't matching or that aren't contributing to the 401k, certainly when there's a match, just a bad idea. So this is a really great idea to reduce your tax liability and also create wealth. A Roth 401k is very interesting because a couple of years ago, one of our attorneys came to me and he said, "Hey, Jim, we don't have a Roth 401k." And I went, okay. But if you do not itemize your deductions and you have the opportunity to participate in a Roth 401k, it might make sense to participate in the Roth 401k. And the reason is, you're not going to get as much of it may be tax neutral effectively. Okay. So Emma is 30. She's unmarried with dependents and earns $40,000 a year. Emma has no medical or dental expenses, no long-term care premiums, doesn't own a home, pays little state income tax, and has no charitable deductions. So these are the typical itemized deductions. Because Edith doesn't itemize her deductions, it makes sense for her to consider a Roth 401k, all right? Because she's not paying that much tax anyway, okay? And this money grows tax-free. So Roth 401k. So a value of a Roth IRA or 401k, as you know, who have done Roths and 401ks, Roth IRAs and Roth 401ks, there's no RMD at age 72, okay? And this minimizes your income taxes in retirement. I met with a client recently who had a $5 million IRA and is turning 72. Well, those minimum distributions are a couple $100,000 a year. And that's not an insignificant amount of money. So this is real. Oftentimes people pay more taxes when they hit their 70s, right? If you have a large IRA. And a Roth passes income tax-free to heirs. A value of a Roth conversion is all of this. And you can couple that with some pretty sophisticated advanced life insurance strategies that will serve to overall reduce your tax liability and increase the intergenerational wealth. So another strategy for all is oil and gas. The season for oil and gas is coming up. Check our website. We've got a whole webinar devoted to oil and gas. The United States is now the single largest oil producer in the world, due in large part to the United States government favoring oil and gas development. Now, climate change, global warming, whatever it is, climate cancer is another way of describing it. Just set that aside for the moment. We do need to drill oil. We need oil and gas for pharmaceuticals, for medical equipment, for a whole litany of things. We are going to talk about solar a little bit later. There are environmentally friendly ways to drill for oil and gas, but oil and gas is tax advantaged under the Internal Revenue Code. And you have an intangible drilling cost deduction of 75 to 80%. So you put your money in, you put your investment in, you got 100,000 sitting there, you put it in, you're going to get a nice deduction, right? Not as great as a credit. And that's an intangible. And you can use to offset any form of active ordinary income, okay, if it's a general partnership, all right? And so this is something where you work with an advisor and you work through these issues and you maximize it. If it's a limited partnership, you're taking it as passive income and you get some depreciation and depletion allowance. So we have a whole webinar on this coming up here in a couple of weeks. I'd encourage you to sign up for that. So charitable remainder trust is, a lot of people look at these and a lot of people do them because they are a method of avoiding picking up an income tax deduction, avoiding payment or delaying payment of estate tax. So it's a deduction and a deferral strategy, and frankly also helps charity, which is a good thing. So a charitable remainder trust is a bucket. Think of it as a trust. A trust is a bucket, right? And you put an asset into this bucket, and then maybe you sell the asset, right? So, and we'll have some examples here of in the slides that follow. The charitable remainder trust pays income to the beneficiary, so the person who put the money. So I put assets in a charitable trust, the assets are sold. I get an income stream for a period of years or for life. This is a split, it's called a split interest vehicle that allows contributions to be eligible for a partial tax deduction and donating the remainder. So as we go through this, that's sort of the black letter law. So Bob and Sue, we have Bob and Sue on the left here, create a charitable remainder unit trust, and they transfer their fourplex into this charitable remainder unit trust. The charitable trust sells, not Bob and Sue, but the charitable trust sells the fourplex for $2 million to this lovely purchaser on the right-hand side, a young real estate investor. And now, so the real estate investor gets the property and $2 million flows into the trust. So what happens next? Bob and Sue get 5% of $2 million for their lifetimes. Not bad, right? It's $100,000 a year. And it's $100,000 the first year. Every year, this kind of resets. So if the investments go up 10%, their $100,000 is going to be bigger. If they go down, it's going to be less than $100,000. And Bob and Sue receive, under this hypothetical, a $548,000 income tax deduction. And there are some limitations on how much you can use against income. And this carries forward for a few years. So this is a way of getting a great income tax deduction. So Bob and Sue might have an IRA and they go, gee, I'd like to convert this IRA to a Roth. It might be good to put these two together. So this is what we would call a Roth conversion strategy. And if this is just blowing by, you're like, Jim, you're talking so fast, I don't understand anything. The whole point of this is just to open your mind that there are planning strategies out there. And these obviously we slow way down when we meet with clients and we walk them through brick by brick, element by element of it, and craft a plan that works for each individual. But when Bob and Sue die, the charity receives $1.6 million. Let's say that's what's left over. The children receive nothing. Okay, so what if they want to leave something for their children? Well, maybe they can use some of that $100,000 to buy life insurance, and the children get the death benefit when they pass away. So this is also called a wealth replacement trust, right? So you couple the purchasing of life insurance to replace the asset that would otherwise go to the asset that goes to the charity that would have otherwise gone to the children. So I'm going to answer a couple of questions. We've got a couple of questions here, and we have Anonymous asks, are all retirement accounts counted toward my mom's gross estate when she passed away? Yes. And will I eventually pay taxes on that when I inherit it? Yes, unless it's a Roth. Maybe she should gift it to me now. I don't know. That would be something to talk about. Do any retirement accounts get a step up in basis on my mom's passing? IRAs and 401ks do not. Is she better off to hold on to them and not gift them now? I couldn't give you advice. Again, this is information only. You can certainly reach out to us, go to our website and schedule a time to talk. For an IDGIT, the intentionally defective Grantor Trust, if my mom transfers her house now and files a gift tax return, can the house be included in her gross estate to get a step up in basis at her death? It can, and that was, it typically isn't, but we had been doing that with the Prop 19 matters. Let's see. So we have an RCLAT. So this is a variation on the charitable trust. This is a charitable lead trust. Charitable remainder trust means you make a gift to a trust and the charity gets the remainder. They get what's left over. A charitable lead trust means the charity gets the lead gift. The charity gets the income. And after a period of time, after a term of years, the difference between a unitrust and an annuity trust, a unitrust is measured by a person's lifetime. An annuity trust is measured by a term of years. Just forget commercial annuity from life insurance companies. That this is small a annuity, okay? A retirement charitable lead annuity trust, you put money into it, the charity gets some income over the years, and then that charitable lead annuity trust ends after a term of years, okay? So this benefits charity, reduces a W-2 employee's potential tax liability now while saving for retirement at a future date. So here's a case study here. Carol, age 43, contributes $250,000 to a charitable lead annuity trust. She gets a $250,000 income tax deduction, resulting in a tax savings of $92,500. Now, this is the highest rate, the marginal rate. That's a lot of money, folks, because our tax system, our income tax system, is a confiscatory tax system. Now, what I mean by that is the money goes to the government and it never comes back to you. We also have a social tax system, which is Medicare and Social Security. You pay into Medicare, you pay into Social Security, and you get a benefit later on in life. And with the confiscatory tax system, that $92,000 goes out the window just in 1 year. On our example here, the term of the retirement charitable lead annuity trust is 33 years. So you can put those two together, 76, you can see this is a retirement structure. The total distribution to charity over the 33-year period is $435,000. They get more than $250, right? The total benefit to Carol is $1.6 million, but the total out-of-pocket cost is $157,000, meaning in the future, Carol will benefit. But the total cost is $157,000, kind of a 10x multiple. It's a very powerful strategy. On this one, you got to be younger. It's not really working if you're 70, but if you're a high income earner in your 40s, 30s, 20s, it really does work, maybe early 50s. But you need a fair amount of time to bake this thing, right? It needs to sit for a while. But this can be a very valuable strategy, very, very powerful strategy. Kind of a basic one for retirees. This is basic tax hygiene. That's sort of that fifth level. If your income is greater than 174,000, which many of our retirees are, if you get Social Security, maybe a pension, and then your RMDs, you might be pushed up into that tax bracket. And you're married filing jointly. Once you pass that $174,000 mark, even if you deduct your income, you're paying more for Part B and Medicare. And for other filers, the limit's $87,000. If you make a gift of your RMD directly to charity, not take it out, put it in your account, and then write that check to your, wherever you attend religious services or whatever, give it to the dogs or nature or whatever your charitable cause is, you might want to think about giving it directly from your IRA to the charity. Now that you kind of have to contact those people and put them in, connect those two people, but then it doesn't land on your taxable income. And this is a really powerful strategy. It does save you. And this is the real deal, folks. And again, this is basic hygiene. But if you're going to make a charitable gift and you have RMDs from your retirement account, you really should think about making it directly to the charity, because it does keep it out of your 1040 and reduces your overall out of pocket. Is a gift of stock better than cash? So I'm going to go through this a little slowly. There's a lot of numbers on here. Remember Bob and Sue? They're the ones who set up the Charitable Trust. They bought Amazon. They bought a few shares of Amazon for $1,000. That's when you could buy Amazon for less than $1,000 a share. And now it's worth $11,000. So if they donate the stock for $11,000 to charity, Bob and Sue can turn around and buy the stock, the same Amazon stock, and you're not subject to the wash sale rules because you haven't sold it. You've gifted it. Okay. Typically, wash sale rule is if you buy and sell the stock within 30 days, your basis essentially carries over. You can't really do that. So Bob and Sue now have $11,000 in Amazon stock with an $11,000 cost basis, and the charity has $11,000 because they sold the stock. Again, this is that fifth element. This is the basic tax hygiene. This increases their cost basis and saves Bob and Sue taxes going forward. So this is part and parcel of when I said that people don't really think enough about this. A lot of times Bob and Sue, they might just write a check for $11,000 to the charity, and then they meet with their CPA, in February, and they go, oh yeah, last October we gave $11,000 to our church, and they could have given the $11,000 in stock. So this is where you want to check in with your advisors. And this is where you want to basically assemble your A team. I don't know if you remember that show from the 80s, to assemble your A team and really pay attention to this stuff, because this is going to get more important. I saw today on the Wall Street Journal, there was kind of a flash article that came out that said Biden's, and I say this apolitically, I'm just identifying who our president is, but Biden's tax proposal already bakes in a capital gains increase effective April of 2021, which was last month. So it is possible that the capital gains increase could be retroactive. They're talking about basically doubling the federal capital gains tax rate for gains over $1 million, which would push it about to 56% for Californians. So a very high tax rate, could be retroactive. I don't know. I'm not clairvoyant. I don't know what's going to happen. But again, this kind of goes to basic tax hygiene. This is going to get more and more important as time goes on. Annuities. So this is not an annuity sales thing. I'm just identifying annuities are tax advantage contracts issued and sold by financial institutions. That is what they are. They are designed typically to have the goal of paying out a fixed income stream later on, typically in retirement, mainly used for retirement. And this kind of helps people address this fear of outliving their money. It doesn't matter how much money you have. Some people are afraid of outliving their money. I've talked to people who have a lot of money, and guess what? They're worried about running out of money. So that is the purpose of an annuity. And you put money into an annuity and it grows tax deferred. So you remember tax credit, tax deduction, tax deferral. Okay, so this is that third tier. There is a tax benefit here. And again, this is where you meet with a financial advisor and you kind of go over everything, and an annuity might be appropriate. It might not be appropriate. I have no idea, but it is a tax deferral strategy. So, you know, and the institution issues a stream of payments at a later point in time or not. Many people die with an annuity. Okay. Typically, if a person dies owning an annuity and a person, and not like the kid, inherits that annuity, typically all of that gain comes out in 1 year. There is a strategy, and there is one company that I'm aware of that does this, where you can effectuate a tax deferred exchange into a different annuity so that when the kid inherits that annuity, all of that gain is paid out over time. Again, a tax deferral strategy. And if you look on our YouTube page, we have a whole webinar devoted to annuities with Ascent Wealth Management. So I would encourage you to take a look at that. And the 1031, again, we have a whole webinar on 1031s. What is a 1031? A 1031 exchange is a swap of one investment property for another. If you own real property, the government, basically for 100 years now, the government has said, we want to encourage the building of the development of land, right? We want to encourage people to build commercial, residential, industrial, and be able to build something and then sell it and take that money to a new structure or a new building and not pay tax and defer. This is, again, it's right, tax credits, tax deductions, tax deferral. This is a deferral strategy. Many of our clients take advantage of this. You may be one of those people who says, wow, that 1031, what a great thing. It's even a verb. Okay, people say, let's 1031 that building for another. And this is something that is well known by realtors, title companies, investors, and yes, soccer moms. Everyone talks about 1031s, but this is on the chopping block potentially with Biden. Now, again, I'm not clairvoyant. I have no idea what's going to happen, but there are some limitations for 1031s. So if you're kind of on the fence on a 1031, you know, it's May. The clock's ticking. You might want to think about that. So here's how a 1031 works. Owen buys Greenacre in 1981 for $1 million. The property's fully depreciated. So for those of you who don't understand what depreciation is, the government pretends, if it's residential or commercial, it's a different time period, but even over about 30 or about 40 years, depending on the use of the property, the government pretends that that property kind of falls down and goes away. It just depreciates. It just erodes and it disappears. It's kind of a legal fiction because obviously the property's still there. There are buildings that are 100 years old, but they require rehabilitation and whatever it is. And you get a tax benefit from that. So this is one advantage of investing in real estate, is you can buy rental real estate and you rent it. And let's say your expenses are $1,000 and your rent's $1,000 and it's a wash. You also get an extra, you might get a $200 income tax deduction, a deduction. So you're paying a little bit less in tax. That's what depreciation is. So let's say the property is fully depreciated to $100,000. Owen sells Greenacre for $10.1 million. Not bad, huh? He's held it for 40 years. Owen can pay the $3.71 million in tax, and that's a real number because he's a California resident or the property's in California. Or he can 1031, again, a verb. He can 1031 the property into a new property and defer the tax. Big trap. If you have property in a single member LLC, a disregarded entity, you do not get a step up in basis on that property. It's very important to know that. That's something, there's a workaround in the year of death, but you have to be Johnny on the spot with it. And I will tell you, certainly not enough lawyers I would hope that CPAs would know this. I doubt financial advisors would know this, but this is a really big deal. And in a partnership return, when a partner dies, if an LLC is taxed as a partnership, there's something called an Internal Revenue Code Section 754 election. That means that if somebody dies, the assets that are in the partnership, you actually can get a step up in basis on those. You can't with the single member LLC. So it's a potential trap. So John asks, on an inherited annuity, is the gain taxed as regular income or long-term gain or included in tax as part of the inherited estate? I would say yes, it's going to be taxed. There's going to be income, long-term gain. There's just a variety of, it depends on how all of that, the gains were booked, but the entire annuity is included in the decedent's gross estate. So one of the challenges we have as estate planning attorneys and tax planning attorneys is when you have a tax deferred asset or a tax advantaged asset, like a 401k, an IRA, an annuity, when a person dies, the full value of that IRA or the annuity or the 401k is included in the estate. But then what the person inherits is also then subject to income tax. So these are, I wouldn't say these are toxic assets. They're like lowercase t toxic assets, kind of, because you're really double taxed on those, right? All right, strategies for business owners. So qualified business income. This is from the 2017 Tax Act. This is the Trump Tax Act that is ending, right? Because it did not get 60 votes in the Senate. It is sunsetting after 10 years. The business must be a pass-through entity. This is really important, must be a pass-through entity, typically an SCorp. If you're a business owner, please pay attention to this. You probably are, if you have a good accountant, CPA, this is already happening, okay? You don't get, this does not apply to C-Corps, okay? But at the individual level, owners of pass-through businesses pay tax on their business income at the individual rate, not the corporate rate, and you get a 20% tax deduction. So this is how it works. Carl owns, shocker, a Carl's Jr. restaurant. Carl's business income from the SCorp that owns the Carl's Jr. restaurant is $1 million. Carl deducts, it's not a credit, it's now a deduction, it's that tier 2, deducts 20% or $200,000 from his income, saving $74,000 in federal taxes, plus state income taxes as well. It's a very powerful tool. This does not apply to lawyers, does not apply to accountants, does not apply to engineers. Apparently, architects get this, but professionals typically don't get it. And if you're in business, you probably already know this. You're like, hey, that's great. I'm paying less in tax. You know, I can't deduct my state and local taxes, but well, I'm getting this 20% deduction. So this is very favorable to business owners. Now, if you're a business owner, you really do need to pay attention to this. Why do people choose to incorporate their business? There is a meaningful, needle-moving tax reason to incorporate a business, an ongoing concern, as opposed to having it be a sole proprietorship. Okay. Now, what an SCorp is, an SCorp refers to a type of corporation that meets specific Internal Revenue Code. That's what IRC means. Internal Revenue Code requirements that allow the SCorp to pass through the income to the shareholders. So there's zero federal tax. So that is, you know, when you hear people say, oh, well, corporations should pay their fair share, S corporations don't pay any tax. That flows down to the individual. Okay. This is typically associated with small businesses. There's a limitation on the number of shareholders. You know, Apple is never going to be an SCorp. It's not going to happen because there's too many shareholders. So the SCorp status gives the business the regular benefits of incorporation, which is limiting your liability, which is very important. And you enjoy the tax privileges of a partnership, meaning the income flows through to the individual. Typically, the individuals, it's going to be more tax advantaged. So let's look at I think QBI, when is, Shika asked when is QBI ending? I want to say it's 2026 when the Tax Act ends, but you'd have to fact check me on that. I'm not remembering off the top of my head. Well, could end, who knows? Could end next week. We don't know, right? Who knows what's going to happen. So cash balance pension plan. This is another really important planning tool. I see a lot of clients use this. A cash balance pension plan is like a 401k on steroids because you're maxed on your 401k, right? 50 odd thousand you can put in there a year, depending on your age. A cash balance pension plan is a pension plan with an option of a lifetime annuity. It is called a defined benefit plan. My grandfather worked as a tool and die maker at General Motors in Detroit. And when he retired in 1973, he got a defined benefit pension plan. He got a fixed dollar amount every month. And I think he had an inflation adjuster in there. That's different than an IRA, 401k or an IRA, right? Now everyone has 401k and IRA. I retired. How much do I get? I get $1 million. You're not getting $5,000 a month. Here's your $1 million, go figure out how to invest it. So that's a defined contribution plan. So that's kind of the fork in the road. The defined benefit plans, I would say those are a little bit older, essentially. But the employer, how this works is the employer credits the participant's account, in this case, potentially a business owner, with a set percentage of their yearly compensation plus interest charges. And, it doesn't matter what happens to the portfolio. The final benefit has to line up. So these are regulated in the sense of not government regulation, but you have to work within the parameters of the cash balance pension plan. Now, here's the biggie. Contributions can be as high as $336,000. That blows away the 401k limitations, okay? These are tax deductible. You're saving yourself in California $150,000 or more. They're tax deductible to the business. And a defined benefit plan, as I said, is a fixed sum for life, not a defined contribution plan. And the cash balance pension plan is a pension plan. This is very important with the option of a lifetime annuity. You can also choose to roll it over to an IRA, right? At the end of this, you can choose to roll it over to an IRA. It is not uncommon for me to see people who are working with cash balance pension plans over $2 million, okay? So this is a great way if you're a business owner. Again, this is something that I'm not sure is getting enough airtime with business owners. It's not getting enough airtime, I know, with lawyers and CPAs. And it's something that I'm really glad you're watching this because you're just empowering yourself with more knowledge. So here's an example. Sam is a plastic surgeon with no employees, right? At Sam's age, he can deduct $336,000 and put that into his cash balance pension plan. The tax benefit, remember we talked about quantifying this tax benefit? He's paying $124,000 less in taxes. He's saving $125,000 in taxes a year. This, again, is a tax deferral strategy. When the money is paid to Sam in retirement, it is fully taxable as income, unless, of course, he does a Roth conversion. So, commercial solar. This is a really big one. We're doing a lot of commercial solar. And when I mentioned at the very beginning, listed transactions, this is about as opposite of a listed transaction as you can get. And I'll tell you why, because the current President Biden has a push for renewable energy. California has a push for renewable energy. We are so far away from the goal. I think we're at like 3% of goal, okay? It's almost like a gold rush going on for this commercial solar. And I'll show you why and walk you through it. But here's what's happening. The government is giving you tax credits, tax deductions, okay? Tax credits and tax deductions, the top two things that you want in tax planning, okay? So solar energy is increasingly viable. The technology's catching up. The Lawrence Berkeley Labs reports that the cost of utility scale solar projects, and that's what we're talking about, has fallen 70%. 70% from 2010 to 2018, meaning the cost of installation is dropping. So it's starting to look more viable as a business. This is a huge opportunity for investors. Don't miss this. Don't ignore this. A real opportunity for investors. Now, this is not installing a solar system on your home or business. That's not what I'm talking about. It's not, call 1-800-INSTALL-SOLAR, should I install solar or not? This is investing in a business that builds a solar project. It owns the solar project and collects recurring payments from large corporations, nonprofits, and government agencies, not individuals, big companies, nonprofits, government agencies, in exchange for providing them clean, renewable energy and reaping tax credits, again, tax credits and deductions, and quite frankly, a lot of profits. So the commercial solar benefits are the federal tax credit, 26%. You put in $1, you invest $1, you get 26 cents coupon toward your federal taxes. Super powerful. Bonus depreciation, 85%. So not only do you put the dollar in, but now you're going to get an 85% deduction and a 26% credit. And we'll have an example here that brings it home. Again, state depreciation, California, for example, didn't adopt the, of course, didn't adopt the bonus depreciation. That's over 5 years. But you know what? If you're living in California or have income producing assets in California, you're going to be paying California tax anyway. It's either pay now or pay later. But this does offset future tax liabilities over the next 5 years. So on commercial solar, we typically see clients own 100% of the project through a single member LLC. You're entitled to 100% depreciation, but 85% in bonus depreciation, the 26% tax credit, a power purchase agreement. So I was working on some yesterday and this morning for the LA Department of Water and Power, AAA rated. LA Department of Water and Power, folks, they're going nowhere, okay? They're going to pay their bill. This is an opportunity to install a solar project and sell the power to LADWP. Like this, it doesn't get any better than that. And you can do cash out financing. So if people say, look, I pay a lot of money in taxes, but I want to take that capital and I think I can make more on it doing something else, you can actually finance these. You can lever these. So there's an ability to do cash out financing. So I'm going to go through with you one deal that I was working on yesterday. This is an LA Department of Water and Power project. The client writes a check for $1,965,000. That results in a $590,000 tax credit. $729,000 depreciation value, meaning the depreciation, that's the tax benefit. Remember I said tax benefit? That's why I was talking tax benefit at the beginning. We need to compare apples to apples. The tax benefit, $729,000. The California state depreciation is $256,000. The net out of pocket is $391,000. So you put in $2 million, and assuming you're in the highest tax rate, net out of pocket, $391,000. And this thing cash flows for 20 years at $62,000. Wouldn't it be nice to invest $400,000 and get a $62,000 payout from a public agency like LA Department of Water and Power for 20 years? Yeah, it's kind of a no-brainer. All right. So you put $391,000 into the machine. What I did, NPV is net present value. I just went out 20 years. The net present value is $1 million. You're $600,000 ahead. And look how that lines up with the federal investment tax credit of $590,000. Here's the bottom line. The federal government is making a push to stop pumping oil out of the ground. We're seeing that. They want to convert to renewable energy, all right? And this is what they're doing. And when you add these numbers up, it's interesting how they line up, and that the federal investment tax credit, basically the government is paying you to build out solar in the United States. So this is not easy stuff, folks. It's time to consider assembling your A team for 2021 and beyond. This is the A team from the 80s. I know there was a newer show, but this is the A team that I knew. And this is something that you should be looking at year over year. So go ahead and subscribe to our YouTube page. How do you get started? You can go to CunninghamLegal.com. I'll show you a couple of slides how to get there. Request a consult by completing the request for an appointment. Please mention you're seeking an estate planning consult and wish to save taxes. So this is estate and tax planning. And this is how you do it. You go to tax planning right there, advanced high net worth people. And that takes you to this page. We have a whole section of our website that's devoted to advanced planning strategies for high net worth families. And you can go ahead and request an appointment on our home page. So I will open it up for questions. We do have several questions here. And let me, and I'll leave that up there so you know how to get to us. Let's see. Let's see. Should a gift be done 3 years before 2026 to count toward 11.8 million, or can I gift all 11 million in 2025? Jim, great question. The current law says that January 1 of 2026, the Trump tax boost of $5 million for the death tax exemption that cuts your death taxes $2 million, right? We have 11.7 million because it's 6.7 million plus 5 that during the Trump era we got. That goes away January 1 of 2026. However, gifts made within 3 years of death come back into your estate. This is a really good question, and I'm really glad you asked it, Jim. even if Biden doesn't get his increase on the death taxes, people will need to finish their gifting by December 31 of 2022 in order to be outside of that 3-year window. So very, very important. Q&A, what is the minimal participation in one of those solar projects? Currently, it's active participation of 100 hours. We're anticipating that that will likely start paralleling oil and gas, where you won't have participation requirement, but that's not part of the law, but it is 100 hours. And I did one in New York City. So I'm going to New York City to visit the project, and that counts toward the time the site visits, and it's legitimate. And I got to tell you, this is actually really interesting, that the solar projects, I mean, I did it myself, and it's kind of cool. I mean, you learn a lot of stuff, and frankly, it's nice to be able to help the environment and get the renewables going. I mean, I'm in Northern California, and we get fires because of electrical generation, and it would be nice to minimize that risk. Lome asks, how can we find out more about the LADWP program? That you would contact us. So go ahead and ask to speak with us, and we can certainly connect you with that. Michael says, how many years are tax credits usable? There's a California goes 5 years forward. There, I believe there's a carry forward. I did not mention there. You can go back and file an amended return and get a refund from the prior year. So very important. Minimal investment in the solar projects. It's project by project. Realistically, it's going to be, 500,000 is the smallest ones that we're seeing. But this is also a way to offset a Roth conversion. So you might have money in an IRA and you want to do a Roth conversion. It's a way, or take it out of your retirement account and get an offsetting deduction. So a lot of different strategies. Gail says, what's the minimum you can invest in LADWP program? It's probably 500, I would say, is the minimum. And for it to be viable, probably 500 to $1 million. Some of them are as high as, we were working on one that was 9 million. So, but it's a great strategy and a great way to help the environment. And any other questions? Let's see. Oh, thanks, Lola. And James, go ahead. And what I'm going to do, Nick, if you can screenshot, I don't know if you can see James's comment, we'll reach out to him directly. Julie says, I'm kind of confused. We're an SCorp. Welcome to my world. We're an SCorp. All of our income flows to us as shareholders, individuals, W-2. So of the options you discussed, which pertains to us, the W-2 or business owner? You would be the business owner. So interesting. What you're describing, Julie, is what Julie's saying is we have an SCorp and we take a paycheck from our SCorp. And then she takes the rest as dividends. So you're actually both. You're W-2 and business owner. But I would put you in the class of business owner if you own shares in an SCorp, Julie. So you're a business owner. Make sure and check out our oil and gas is coming up. And if you're watching this recorded on YouTube, it's going to be on one of our more recent videos. I think it's up in a few videos from this one. But I want to thank you all for joining us here today. Great questions. Great to spend some time with you. I hope you guys learned a lot, and have a great rest of your day.